What is up, you guys? Nick here, and in today's video, I want to talk about a topic I don't see being discussed nearly enough, and that's the topic of index funds, mutual funds, and ETFs. You know, in this world of high risk, high reward, fast trading, with everyone trading, penny stocks and single equities, I really want to bring it back to the basics and talk about the foundational funds that should be the root of your portfolio. I find so many young investors these days their portfolios are all out of whack, all over the place, in a ton of penny stocks over here and just single equities over here, and nothing's balanced and they're not diversified, and they're really open to certain specific sector downturns, which could absolutely shutter through their portfolios. So I really want to get back to the basics and talk about, the best ways to begin investing if you're new to investing, or if you're not new to investing and you just want to broaden your horizons, get back to the basics and really shore up your portfolio. I'll be talking about some of my favorite index funds, specifically ETFs of the Vanguard company, and we'll be talking about the ins and outs of specific funds. With the volatile market we're currently in, and so many of the uncertainties that are looming in early 2021 and moving further into that year, we really don't know what's going to happen, and the market is likely to be extremely volatile for the foreseeable future. And I think it is a very good time to, get back to the basics, slow down, diversify your portfolio through index funds and ETFs, and I want to talk about why that is and my favorite ETFs. All right, so what is an index fund? An index fund is essentially a basket of different funds, and it can hold tons of different stocks, can hold tons of different bonds. It's just a pooling of these into one single fund. So unlike investing into a single stock, which usually represents a single company, when you invest in an index fund, you are investing into a pool, a basket of maybe hundreds, maybe thousands, maybe tens of thousands of different stocks and bonds and different allocations of assets, all nicely packaged into this one specific fund. And by doing this, you are really broadly diversifying your portfolio instantly. So there are mainly two different types of index funds, and these are called mutual funds and ETFs. ETF is exchange traded fund. And these two are really similar in most ways. The only difference really is that ETFs are more user-friendly. You can trade them just like stocks on the market, so throughout the course of the trading day. They come with management expense ratios that are extremely small, so they don't cost much at all to be managed by a professional. Whereas a mutual fund is a bit more difficult it's not as user-friendly. You can only purchase them after the trading period is over for the day. They're typically actively managed by, some bigwig Wall Street people who are taking larger sums of money to manage them. An ETF, on the other hand, is usually passively managed, where it's essentially just following a certain index. And we'll get into that more a bit later, but just so you know, an ETF is more user-friendly. You don't need as much capital to get in on them in the first place, whereas mutual funds are actively managed by some, big professional choosing which assets to allocate. Maybe he wants 20,000 shares of this company and he'll sell 30,000 shares of this company. Whereas an ETF, it's sort of passively following a certain index. So that being said, ETFs are typically cheaper with smaller MERs or management expense ratios, whereas mutual funds are actively managed by professionals and thus have higher MERs or management expense ratios. So what is an index? Well, there are many different types of indexes, the Dow Jones Industrial Average, the NASDAQ, the Russell, the S&P 500, there's tons of them. And some follow, the entire economy, some just follow certain sectors. And it's essentially a way for investors and analysts to get a general gauge of how the entire economy is doing or a specific sector. So taking the S&P 500, for example, this is a holding of 500 large companies within the United States. The things you would know like Apple, Facebook, Google, Alphabet, the big names, Johnson & Johnson. And it's essentially just following these companies. So if you hear that the S&P 500 did well, was up, it means that the conglomerate average of all those 500 companies performed in the green, in the positive for the day. Thus, the S&P 500 for the day was up. Now, the companies within the S&P 500 do change over time and have changed in the past. You might have heard that Tesla is being introduced into the S&P 500 very soon. So they are fluctuating in and out but they are typically 500 of the largest companies within the US. Now, what an ETF or an exchange traded fund is doing is it's following or tracking a specific index. So S&P 500 index fund is holding the exact same companies in the exact same weightings that the S&P 500 index is holding. Therefore, if the S&P 500 had a good day, therefore, no matter what, the S&P 500 index fund also had a good day because it's holding the same companies in the same weightings. Now, this is very beneficial for investors because, like I said, an ETF is traded just like any other stock on the stock market. So when you buy an ETF following the S&P 500 index, you're essentially becoming exposed immediately to those same companies in the S&P 500. Therefore, all this being said is that you are greatly diversifying your portfolio by choosing ETFs. You're choosing a conglomerate of companies instead of just one single stock, one single company when you buy a single particular stock. Now, if we look at the S&P 500 over time, we can see that increasing overall trajectory over time. And although no one can predict the future, especially within the stock market or the economy, we can look at the past. And I wouldn't want to bet against this track record. It has an average of a roughly 7-8% increase every single year since its inception. And that's actually a great return on a portfolio. So maybe you're just starting out in investing, you're looking to get into it, or maybe you've suffered some losses and you want to shore up your portfolio, diversify, and get into index funds. And you've definitely come to the right place, and I do think you should be investing in index funds for the long term. So there was this guy named John Bogle who came up with the idea of an index fund, and he created a company called Vanguard, which is still one of the largest distributors of index funds in the world currently. And they also happen to be my favorite. I really like them. They have the smallest MERs pretty much out there on the market. So you're paying basically nothing to actually hold these index funds. So the first fund I want to talk about is what many investors and analysts actually use as their foundational backbone fund in their entire portfolios. I know certain people that only hold this fund. They don't hold any single equity stocks. They only hold this fund and put all of their investments into it. And that's because it is so diversified and tried and true. It performs time and time again. And this is VOO, Vanguard's S&P 500 Index Fund. So like I was saying earlier, talking about the S&P 500, this fund pretty much exactly follows the S&P 500. Let's open up Vanguard's website here. This is the ETF homepage. Basically, you could scroll down, you see 33 matching ETFs. That means they have 33 different ETFs or exchange traded funds. And you can go through, here's the large cap funds. A large cap company is the biggest type of company. There is like mega large cap, but a large cap is over $10 billion market cap. So these funds are going to be holding some of the biggest companies, probably some brands you're aware of. But the first company I want to talk about, which I already hinted at, was VOO S&P 500 ETF right here. So if we go through it, we can see its unbelievable performance over time. However, a good thing to look at is the risk potential. And we can see it has a risk potential of 4. And I'll get to why that is and why this is a bit more on the risky, high reward side of ETFs as far as they go. So what we want to look at for here is the expense ratio. That's 0.03%, which is actually incredibly low. If you had $1 million worth of this stock, you would only be paying $300 per year to actually hold all that investment. Category, we can see large blend, so it is mostly domestic large cap companies. We can scroll down here, we can see its hypothetical performance of $10,000 10 years ago would now be worth $37,000, which is a pretty good yield. However, we have been in a crazy bull run, so that might change over time. Another thing you want to check out is the portfolio composition. And what I do like so much about VOO or VFV, if you're Canadian, is that it is so broadly diversified. You can see 11% of communication services, 11% consumer, 2% energy, so pretty low on the energy side, 14% healthcare, and it's really tech heavy. Obviously, those top big FANG stocks holds so much of the S&P 500. Okay, so now we can look at the number of stocks. It holds 508 different stocks with $557 billion of total net assets. This is just incredible. This is a huge amount of money within this fund. Its 10 largest holdings are pretty spaced out only holding about a third of the entire fund. However, look at these companies, they're all massive. Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire Hathaway, that's Warren Buffett's company. So you are in very good hands within this fund. It's really not going anywhere, and if we look at the track record over time, it's not a fund you would want to bet against. I can't see any of these companies going anywhere anytime soon, and that is why it is the foundational fund to my own personal portfolio. Now, I'm not a financial advisor, I'm not telling you what to do, nor should you just blindly take somebody's word for it on the internet. So you're gonna have to make your own choices when it comes down to which funds you want to choose in. But I'm just saying this is one of my personal favorite funds. It holds roughly 75% of my entire portfolio. I'm really not too invested in single stocks. There are a few that I have quite big positions in, but this fund is the foundation. It's the backbone to my portfolio. So now I want to talk about why this risk potential of 4 is there. So many ETFs have lower risk potentials than this. However, we can see that it's only holds stocks. There's no bonds whatsoever in this fund. So the MER of 0.03 is really why I love Vanguard so much and why so many investors just gravitate instantly towards this fund in particular. It's so cheap to hold this stock. So not only are you getting broad diversification within different sectors, you are also getting the largest companies within the United States in one fund. It's all nicely packaged up in there for you, and it's also coming at an extremely small MER or management expense ratio of 0.03%. The industry standard for ETFs is about 0.67%. So you can see the drastic difference of Vanguard funds and why so many people love them. They're basically not taking any money because they are so passively tracked. It's pretty much just copying the S&P 500's movements. If some company comes into the S&P 500, which Tesla is, this fund will pick up the exact same proportional weightings that that company holds within the S&P. So there's really no logical thinking or choices being made by managers. It's really just passively following a certain index. So now heading to the price and performance, we can see how it's done over time. And what we want to look at is the since inception. And we can see it's roughly in the high 14%, which is actually incredible, but it's key to remember that it was made in 2010 and the past 10 years have been extremely bullish. Industry-wide, broad market-wide, the economy has performed exceptionally well over the past 10 years. And look at its 1 years in 17%, which is also incredible. This year has been, such a discrepancy from the actual stock market to how the actual broad market economy is actually performing. However, these companies are so large that they were able to kind of harness the health situation. So this fund is really good to hold. Like I said, it is the foundation to my own personal portfolio and a lot of other investors. You essentially can't go wrong with this long term. It's not holding bonds. However, I'm not personally interested too much in bonds. I am relatively young in my investing lifespan. I have a long time horizon in front of me. Bonds are typically favored by those who are older. They have a shorter time horizon. They really want to shore up their portfolios. They want to de-risk their portfolios, so they start introducing bonds into their asset allocation. However, like I said, I am young. I am more apt to have a higher risk, high reward situation. And I feel like this is the perfect blend of risk and reward. Now moving on to one of my favorite bond funds. And like I said, I am a relatively young investor. I have a long time horizon and I am willing to risk my money for a higher reward at this point in a relatively reasonable amount. And the bond fund I want to talk about is Vanguard Total Bond Market ETF under ticker symbol BND. And what I like so much about this bond is that it is so shored up. As we can see, the US government-backed bonds are more than half of its entire weighting. It's 59.4%, so more than half of these are government-backed bonds. These loans are highly unlikely to be defaulted upon. We can see 3.8% AAA and 3.6% AA and so forth. It is very shored up. There are $293.4 billion of fund total net assets, 9,976 number of bonds, with an average effective maturity of 8.5 years. So people do like this fund because it is so reliable. If we can see its price and performance, over time, you will see just a steady increase over time. Now, you're not going to get the kind of increases you would potentially get with VOO or VFV. However, you aren't typically going to lose money within this fund. See, look at this. There's no really periods of sharp declines. However, if we did go back to the VOO and VFV, we would see some decreases in its price performance. People also like bonds as they perform well when the rest of the economy isn't performing well. So you're kind of hedged against a falling economy. So people might want to allocate more of their portfolio assets into bonds in the coming years as the market uncertainty grows with time. All right, so another thing I want to talk about is the S symbol. They call it the Vanguard Select ETFs. So if you don't hold that many funds, they recommend that you choose, one of these tried and true ones that many investors do hold. See, we can see the VOO S&P 500 ETF is the Select Vanguard. And the next one I do want to talk about is VTI, and that is Total Stock Market. So if you want to be diversified, there is no better option for you than VTI. The expense ratio is extremely small, so $300 on $1 million of assets. It holds large, mid, and small cap equity diversified across and value styles. So what that means is that unlike the VOO where you're only within large cap companies, this is giving you also a blend of mid cap, which is under $10 billion and above $5 billion, and small cap, which is typically lower than $5 billion. It's giving you diversification and exposure to those companies as well. So many people like this because you do have the promise of some of these, small cap companies kind of blowing up and really increasing, surging share price. So there is a bit more risk to reward than VOO because you are holding those small and mid cap companies. Here we can see a 4 on the risk potential. If we scroll down here, we can see their hypothetical growth of $10,000 10 years ago would now be worth 37, so pretty similar to VOO. However, this is just a massive fund. It holds 3,590 stocks with almost $1 trillion of total net assets, 921.4 billion. So this is just a massive fund. If you want to be exposed to every single stock traded on exchanges within the United States, this is incredible. You're holding everything. We can see the usual suspects are the month-end 10 largest holdings, very similar to VOO in that aspect. You can see the broad diversification. It is quite tech heavy with over a quarter involved in tech, so you might want to look out for that. All right, the next one I want to talk about is quite more controversial than the first two, and that is the Vanguard FTSE Emerging Markets ETF under ticker symbol VWO. And what I want to make clear is that this is quite a risky stock. It's a 5 on the high risk. It's more reward as well. However, it is extremely risky. So emerging markets are places around the world such as China, Brazil, Taiwan, and South Africa, which are, quickly developing. Their economies are growing extremely fast. And if you do want some exposure to these emerging markets, this is a great fund to hold. My asset allocation of this fund in my own personal portfolio is extremely small. I think I only own about 5% of my entire portfolio is within VWO. However, I do want to be exposed to these emerging markets. I do see huge promise coming out of places like China and Taiwan. These places are becoming tech giants and at an incredibly fast rate. However, it is more risky because it does hold so many foreign stocks. So you can see it hasn't really quite performed well yet. A hypothetical $10,000 10 years ago would now only be worth $13,000. So very severely underperforming the other ETFs we've looked at. However, we can see it is starting to increase. Just in the past year or so, this has really taken off, and I do think it will continue to take off. So looking at the characteristics, there are 5,002 stocks, 87 billion, so not that many assets actually. We can see Alibaba, Tencent, these are massive companies. What else do we got here? China Construction Bancorp. So there are huge companies within this. Alibaba being very notable. However, there are delisting fears growing within the US House of Representatives currently. So I will have a follow-up to this, but I do like having this stock in my portfolio just because I do want to be exposed to these emerging markets. I do think there's a lot of promise, and I don't think these countries have really had their time to shine yet. And I do think, the United States and North America are kind of lagging right now some of these other countries who are just pushing so hard into their industry and into their technology that I do think there may be a slight shifting of dominance, especially within the tech industry. Anyways, guys, thanks so much for watching. I really do appreciate it. Let me know in the comments what you're currently invested in. I'm always open to hearing your favorite ETFs. Make sure to hit that subscribe button if you haven't already. I really appreciate it. Smash the like button for the YouTube algorithm. It really helps propagate this out into the airwaves. Anyways, I will see you guys all in the next video. Cheers.